Hello, everybody. Welcome to this webinar on the Aspen Private Credit Fund. Very excited to talk about this fund with you all. We're going to be going here. People are jumping in live. So I'm just going to get going right away. And this will be recorded. So if you miss any part of it, you come back and watch it later. I'm going to kind of fly through this. So we have a lot of information to cover. We have a lot of things I'm going to share with you and really show you why we're so excited about this fund. And then I'm going to get to some Q&A at the end. And if you have other questions after the presentation, feel free to reach out to someone on our team. I'll have some ways for you to do that at the end. But in this presentation, I got a lot of things I'm going to cover. I'm really excited to share with you why right now private credit is the darling of the big investors right now. The billionaire funds, the large investors are seeing this huge opportunity in the marketplace with private credit. I'm going to explain what that is, why it's so attractive right now in this current economic environment. I'm going to explain why our fund, I believe, is one of the best designed private credit funds in the market right now, and how we're going and finding deals and how we're structuring it for investors. So I'm going to break that all down, and I'm going to give you the real 101 on who Aspen is, why we're so well positioned to operate this type of fund, given our 11-year track record in this space. So with that, let's jump right in. Obviously, got to give the disclaimer. This is a presentation for informational purposes only. I will make allusions to returns or projections. Those are not guaranteed, and past performance is not necessarily indicative of future performance. Please be sure to review all of our legal documents or private placement memorandum for a full set of risk factors and understanding how the fund is structured, etc. Okay, for those that aren't familiar with Aspen Funds, who is the team behind the name? I'm going to share just some faces here, a little quick background on each of our partners. We have 4 partners here at Aspen Funds. Aspen Funds was started by our 2 co-founders, Bob Frazier and James Mafuccio, in 2012, really as an opportunistic way to take advantage of an opportunity they saw in the market, buying distressed debt, distressed credit. And that turned into another fund, and really has become what Aspen is now, where we manage over 18 different funds in many different verticals. We manage over $600 million of assets across several different verticals in real estate, in debt, and in oil and gas. And then our other 2 partners are Dan Schulte and myself. Dan Schulte, he is a CPA, an attorney. He was a former general counsel at Waddell & Reed, a large money manager firm in town, and he's currently our chief operating officer. And then myself, I'm a chief investment officer and help structure our deals, run the underwriting acquisitions side of our business, and manage the capital markets. Okay, I'm going to talk a little bit about our process for identifying deals. It's a little different than a lot of operators you may see, where some operators are what I call a hammer operator, where everything is a nail, right? They know one thing, that's all they know. There's nothing necessarily wrong with that, but the challenge is different asset classes perform better in different economic cycles. There's better times to invest in certain asset classes than others. And that has really formed the foundation of how Aspen Funds finds, vets, and structures opportunities for investors, is wanting to be positioned with the rising tides, right? A rising tide lifts all boats. And our contention is that being in the right tide is more impactful than being in the right deal or the right market or the right asset class. Now, those all matter, of course, but the biggest driver, the biggest impact to the overall success of a project or vertical is what are the economic fundamentals driving the growth and return in value in that sector. And that's really why we're so excited about this fund, is it's so well positioned in this current economic environment to take advantage of really strong risk-adjusted returns. One other note here that I always like to mention is our team, our principals invest in every deal alongside our investors. That's been our commitment from day one, and we continue to do that. We have an extensive track record here. We've been around for over 11 years. As I shared earlier, we manage over $250 million of investor capital. That's pretty much exclusively high net worth investors, individual investors, over 600 million in assets. And my favorite number is we've distributed over $65 million of distributions back to investors since our inception. We've experienced across many asset classes, as I mentioned, distressed debt, credit, multifamily storage, industrial, and non-real estate as well, with oil and gas. What's on the podcast? So if you're not a podcast listener, be sure to check this out. I think you really love it. It's our way to help educate in this space or alternative investments to help people become better investors. Okay, let's get rolling here with executive summary. We're going to get to the meat of it here. So what is the Aspen Private Credit Fund? Like, Ben, get to it already. Well, our fund is an open-ended fund focused on providing credit to commercial real estate properties. There's a dislocation in the capital markets. It has created a very unique opportunity for non-bank lenders such as us to provide capital through preferred equity, mezzanine debt, and bridge loans, and provide that capital for sponsors and operators to close their deals, to achieve their business plans, where they have been struggling to get the capital they need because of a structural challenge in the capital markets and the availability of capital. And the fund for our investors focuses on providing current cash yield, so you get monthly checks, as well as upside through profit share on a quarterly basis, all the while investing in a preferred equity position or a mezzanine debt position, preferred position before common equity investors in the capital stack. I'll explain why that's so important here in a minute. But some of the key reasons why we love this fund are, one, the high current yield. It can't be understated how important it is to have a large portion of your investment portfolio in high cash flow, high yield type of investments, right? It's so important to have strong yield in your portfolio to drive that passive income and that growth, and ultimately to provide capital security, right? It's so easy to go chase the big returns, the 15 or 20% IRR deals, and sometimes those can work out well. But one of the big challenges is if they don't perform well and you lose money, that is a wealth killer, a compounding wealth killer, and I'll show that later. All of our deals are invested into a preferred position in the capital stack. We have an open-ended fund structure, which I'll talk about here in a minute, which is very beneficial for investors. We have a strong sponsor team. We've been operating this fund for many, many years. Operating funds like this for many years. This is a newer fund, but we've been doing these types of deals for a long time. And just like I said earlier, we like to invest alongside our investors for true alignment with our investors, and that's our commitment to do that. The great thing with this fund is a portfolio. So diversified into lots of different assets. Right now, there's already 6 assets in the fund, and it's growing every single quarter. Okay, let's look at the fund overview here. So this is just a quick look at the fund, how it's structured, and what do you get as an investor, right? So the first thing is regular distributions. This, again, is so important. You invest in the fund, we have an initial 3-month deployment delay, but then you start getting monthly checks on a preferred return. And then quarterly, you'll get an additional distribution for your quarterly profit share. And you have the ability to automatically reinvest as well, which is a really cool feature of the fund, where you can reinvest your dividends back into the fund to compound it and grow it. The way this is structured, open-ended fund, so we have quarterly net asset value calculations. The capital is funded in tranches based on availability. We invest in preferred equity, mezzanine loans, and commercial real estate. And our focus is on generating current cash flow plus profits in preferred positions in the deals that we invest in. This is a non-dilutive fund, meaning new capital coming in is invested into new assets, so it's not diluting other shareholders. The net asset value per share does not go down with new capital. And a high watermark. So we need to continue as operators to continue to grow the value of the NAV per share over time in the fund. And if it drops, if the value drops, if performance struggles, we do not get paid our carried interest as managers if it does not. So it truly creates that alignment in the structure for our investors. We send out, again, monthly preferred return payments, quarterly profit share. Then we set account statements, fund reporting produced quarterly. One of the exciting features of this fund is liquidity. So we have a liquidity provision. You can request a full or partial redemption of your funds after a 2-year lockup period with a 90 days notice. So you get the high yield, you get the liquidity, and you also get the compounding feature of this open-ended fund. Minimum investment is $100,000. Accredited investors only. We are getting a CPA audit on this fund, and IRA investments are welcome. Okay, I'm going to break down real quick. What are the returns? What can I expect in this fund? Well, our Class A shares are $100,000 minimum, and then the other share classes go up on the minimum amounts from there. You get a 6% preferred return that we expect to pay that monthly, and then you get a 70% of the profits above that. So we target a total return, if you include the preferred return plus the profits, about 10 to 12% annually, and that is not compounded. That's if you're not compounding your return. And of that 10 to 12%, we expect 8 to 11% of that to be paid out in cash, right? So there's always a portion of the return that's increasing, staying in the account, increasing in NAV, and you can get that when you redeem your position. But a large portion of it will be distributed in cash. If you compound your return, so you're reinvesting 100% of that 10 to 12 yield back into the fund, you can expect 11 to 14% on your investment. Well, let's talk about macro trends. Why is this so important? What is driving the opportunity here? Well, the real big picture, the real big headline is traditional lenders are pulling back on their leverage ratios because of deals that are struggling, right? Some of the negative and cautious sentiment. So we're seeing a big pullback from banks on new deals, especially with new borrowers. It's very hard to get the same leverage ratios you could have got just a few years ago. The lack of payoffs on banks' balance sheets has really restricted available funds for new deals. So the way that banks work is they use their balance sheet, they use their liquidity, their capital to go and invest and make loans to other deals. The problem is when they don't get payoffs, when they don't get paid off in their current portfolio, it doesn't free up that capital to make new loans. And so as a lot of deals have been kind of kicking the can down the road, not getting the payoffs they need, that's restricting the availability of capital. Additionally, there's real structural challenges in the traditional banking sector with the new Basel III Accord that is going to be adding increased stress on banks. It's going to increase their capital requirements, change the business model, increase liquidity requirements, the compliance costs, the impact on small banks. This is really going to be making it harder for banks to continue to be aggressive because they have more overhead, they have more compliance, and continue to pull back that leverage. At the same time, there's strong economic fundamentals for a lot of real estate sectors, housing especially, which is the primary focus of our fund. There's been a chronic underinvestment. There's a structural supply shortage of housing in our country, and we need more housing. So there's been a big supply of housing being delivered the past really 2 years of new apartments in high supply markets. But that's really starting to be absorbed and expected to continue the trend of a massive shortfall over the next several years. So what's our strategy as a fund? We're investing in a preferred position, and you can see here in the picture the capital stack, right? Either in a preferred equity position or a mezzanine debt position. We have a priority over the common equity. So you can see here in the picture, senior debt, that's the senior lender. They always get paid first. But then the next in line is the mezzanine debt and the preferred equity and then common equity. And so when we invest in these positions, obviously the senior lender has to get paid first, but we're next in line. We're next in line before all the common equity. So that gives us priority of payment before common equity. It gives us current cash flow because we're eating up all the cash flow of the deal after the senior debt is paid before the common equity. And then we're lowering the capital stack. So it reduces our risk of capital loss because if the value of a deal goes down or they can't get the value they want down the road, the ones that get impacted first are the common equity. And so we have that cushion, we have that margin in front of us before the value of our position is impaired. And then the other really powerful thing in this position is we can generally take over the deal or force a sale if it's not meeting expectations. And so we have covenants that the borrowers and sponsors that work with us agree to. And if they're not meeting those covenants, we have the ability to use different leverage points to make sure that they do perform, or we can take over the deal, or worst case scenario, we can force them to sell it. Why is private credit so attractive right now? You can see this from BlackRock. This is on a risk-adjusted standpoint over the next 5 years, where they're ranking the expected return and volatility of lots of different asset classes. The number one asset class is direct lending. This is it's credit-focused deals are going to outperform really a lot of these other asset classes with the least amount of variance of return, which is one way to measure risk, right? So you have a small variance of return with a very high level of return expected in this asset class, why we're so excited about it. Now, let me give you kind of an example here, kind of a case study, right? Because a lot of people say, well, I used to invest in 15%, deals in real estate, and, why would I want, 11 to 14%? I can go get 15%. Well, here's the thing that a lot of people don't take into consideration. One is they're comparing apples and oranges, right? A 15% common equity deal is very, very different than a, say, 12% or 11% preferred equity position. And let me explain why that's so important, right? Because when you're looking at returns, you have to adjust them by the risk that you're taking. When you're investing in common equity, which is what most people invest in, you're taking the most risk. You're the last person to get paid in line. You're the first person they come to when they have a capital call and a capital need to come and make sure they can save the property. And you don't have any control rights. You don't have any ability to take over the deal if it's a bad sponsor, a bad operator, and make it work. And so what happens is a lot of people go chase big returns. And so I have a kind of a case study here. This is $100,000 that's invested in a fund like ours that's earning 11%, and it's earning 11% every year, and it's compounding, right? Kind of boring, sure, but you'll see what happens here in a minute. The other is you go and invest in common equity deals, and you get higher returns, but it's more volatile. So first year, say you just kill it. You get 30% returns annually on those deals. Next year, not as good, but still better than 11%. You get 15%. Next year, you get 15%. Well, year 4, one of the deals you invested in goes bad. But it's not a 100% loss. It's only a 25% loss, right? Well, that impacts the value. But hey, next year you do great. You do 20% return. Next year, 10%, 15%. Oh, a couple years later, another deal goes bad, 30% loss. And then, hey, you have a great run, another 10%, 20%, 30%, 50%, 15%. Great run, another loss. On and on and on, right? This is a very, very common scenario for a lot of investors where they're investing in common equity. There's a lot of variance. But what's the golden rule that Warren Buffett says? The number one rule of investing is don't lose money. The second rule of investing is don't forget rule number 1, right? That's why this is such a powerful thing. And now look at what happens. Consistent returns win. Even though the 11% is a lower return, 1, you're compounding it, and 2, you're not taking any losses. Look what happens over 30 years, compounded at 11%. Your ending account value on a $100,000 investment is $2.3 million. Versus the same $100,000 you invest, you go for this roller coaster ride, you're stressing out in the years that you're down, and hey, you actually still make some money, but you make under $600,000 in 30 years on that $100,000. That's a massive difference in true wealth creation and resting easy at night, right? This is a fact that a lot of people don't look at more is adjusting the returns you're getting for risk and the ability to truly compound. Compound interest is the 8th wonder of the world, as Albert Einstein said. Okay, let's shift back to the fund and how we source deals. We source them through brokers, placement agents. We have a big network there. We source them through lenders that have deals they're working on that need some additional capital to come in. And we also source them through our sponsor network. We've established some great relationships with impressive sponsors, and we're going and continuing to build those great relationships to get preferred deals. really some examples of the deals that we do. I'm going to break down some case studies, and then I'm going to share some frequently asked questions. So the real examples we're doing here, I'm going to share some cases that make more sense, but most of what we're doing is going after new deals, right? These are not distressed deals that are trying to survive and we're coming in as a rescue lender. That's not what this fund is doing. We're coming in and usually doing one of a few things. We're helping them shore up their funding gap, right? So a senior lender falls through or they can't raise the equity in time. We can kind of bridge them in a short-term way to close the deal, get it done. The other is loan assumptions. So these are the one we do several of already, where they are assuming a loan of another seller, but it's usually low leverage because the debt was originated a few years ago. So they need to increase the leverage. We can kind of come in behind the senior debt there. New construction, banks are resident to lend, generally very low LTVs. Goal is to increase the leverage there. There are some examples where we can do existing deals where maybe in certain distress situations, I put that in air quotes because it has to be, all the stars align to be very, very clear that there's a path forward here. And sometimes what can happen is, a sponsor did underwrite to the interest rates increasing, 500% over the past few years, and so they need to purchase an interest rate cap. They need to bolster reserves. They need to finish the renovation program, but they've taken it to 80%. They need to get that kind of final push to get over the hump to then sell. Or capital injection. They got great in-place senior debt. They actually did lock their interest rate in, but they don't want to refinance yet. They want to finish renovation program. They need to bolster reserves, and we kind of come in and help keep the in-place debt and come in behind them. Let's talk about some examples here. So the first one, this is a loan assumption example. This is, a great deal. The sponsor was assuming an agency loan from Fannie Mae. Actually, this was Freddie Mac. They have a 2.9% interest rate. The LTV, the senior loan balance, was at 45%, so very, very low, right? Most leverage on commercial real estate is between 60 and 75%. So very, very low. So when we kind of came in to layer our preferred equity in, it helped increase the investor IRRs because we are cheaper than their common equity, and they don't have to raise as much because of a very, very big amount of equity they have to go raise for a 55% down payment on this property. And meanwhile, we bring up the leverage to about 60% on this deal. And so they're happy because we're increasing their returns for their investors. They have to raise less equity. And we're happy because we got a 40% equity cushion covering our position, and we have some great control rights. So on this deal, we're earning an annualized 14% return with some fees going in and out. It's a 3-year term. They plan on taking us out in 3 years. Here's a picture of the property. Some of the key underwriting metrics that we're looking at is the sponsor team is always the very foundation of what we evaluate first. A vertically integrated sponsor team, meaning they have property management in-house, they have construction in-house. The current NOI supports the debt service of both the senior loan and our loan. So there's much lower risk there because they already have the cash flow to pay everybody. It's a light value business plan. They've done many times before. They have a significant margin for takeout financing at 3 years, meaning that when they look to refinance or sell a property in 3 years, there's a lot of margin for us to get paid off, again, in that priority position before other investors get paid, common equity investors get paid. Here's another deal that we did. This is a multifamily takeover deal. So this was a really interesting deal. This is where the lender kind of originated and put together the deal. So the lender was a debt fund. They're actually in foreclosure on this property with the former owner. They basically reached out to the new group, our sponsor, that is now coming to purchase the property from the old owner. The lender really wanted to bring these new guys in because they worked with them before. They had a great track record, and they had assets in this market. The lender was willing to actually take a discount to what they were owed from the former lender, and then actually lent new capital at a lower leverage point to this new group. And then so we came in with the additional kind of layer of pref, like $1.7 million in this. And we've got a great basis, effectively, right, 25% reduction in price from the prior owner. So they got it at a much lower price, much better basis. All of a sudden, things work when you get it for a good value, right? And the strategy here is pretty clear. It's do value add business plan. It's located in Atlanta. It's in a great suburb of Atlanta, close to the airport. A lot of large employers. They have an asset or several other assets right by this particular asset. The sponsor has 20 full cycle exits. And it's a short-term business plan, so they expect to pay us off in 2 years. So I'm very excited about this deal. I'm going to skip this one. Let's go to this deal. Well, I'm going to go back one here because this is a great example of what a mezz debt piece looks like. So this is a neighborhood retail strip center. So this is an asset class we actually really like. They're very high cash flow types of properties. They're very sticky tenant bases. These are all kind of non-Amazonable types of companies here. Nail salon, insurance provider, a lot of times liquor stores, dog grooming. So those are the kind of tenants that they're looking at here. They're do very well running this kind of post-COVID era, being close to residential locations. And again, it's looking at a lot of foot traffic, a lot of mom and pop owners. They don't know how to effectively negotiate and structure the leases. So there's usually a lot of meat on the bone to go and increase the value by converting to triple net leases and bringing them up to market and continuing to keep the tenant base high. There's a lot of demand and not a lot of supply in these types of properties. So this is a very tight market for retail. This is outside of Wichita and Derby, Kansas. It's a great submarket. The current sellers were not sophisticated kind of mom and pop owners. This is a group we've worked with before, really like them. They have other assets just like this, and this is their home market. And they're doing that simple business plan, right? Taking the current tenants, converting them to triple net leases, bumping them up to market, and increasing the value there. Okay, let me dive into the performance of the fund. And if you want, we actually have deep dive reviews of every single asset in the fund that you can watch in our data room if you want to get more intro. So this fund was launched in the middle of Q2. So Q3 is our first full quarter of performance. Now, obviously, we have done these types of funds for the past 10 years, and we've done in our other fund, the income fund, lots of similar types of deals just like these. But in this case, this is a new fund that we've rolled out and kind of pivoted the strategy to be more expansive to just do these types of things. In the past fund, it was doing a hodgepodge of different types of lending and investing in credit. Now we've pulled onto a new fund, carrying over that same track record, same teams, resources in the new fund. So we've been doing these types of funds for a long time. This fund is newer. You can see here for Q3, we're right where we want to be. With the Class A shares, 6% preferred return. Last quarter, we had a 5.22% annualized profit share that was distributed to investors. And right for that kind of 11.22% yield on investors' accounts. You can see here the asset class summary. So 77% of it is multifamily. That's again where we expect most of the assets to fall into. We have an industrial project. That neighborhood retail is a small loan. You can see here's the net asset value. It's been increasing quarter over quarter for each share class. And here's just some statistics on the portfolio so far. So right now we have a very efficient capital deployment. We've been able to maintain above 95% capital deployment, meaning 95% of the capital that we've have in the bank, we've deployed into assets. So we're keeping that fund yield very, very high by doing that. We already have another $12 million in capital commitments in the fund. We've already deployed $11 million just in the past few months, and expect this fund to continue just to grow like a rocket ship into great deals. We funded 6 deals. I only went through 3. We have 3 other ones that you can watch more on in the data room. Our weighted average LTV, 69%. Weighted average loan to cost, 71%. Our weighted average maturity is 2.19 years. Our gross yield is about 17.88%. No deals are in delinquent status. Okay, next section is a track record. I'm not going to spend a lot of time on this section just because you can review that all in the data room if you like and talk about all the track record we have in credit in our other funds. But here's an example of what we kind of see the portfolio looking like over time in this fund. About 50% or so will be in preferred equity, 25% in mezz loans, 25% in bridge loans. Really, one of the unique things in this fund that's really positioned it well to do well in this market is we're targeting $1 to $5 million check sizes per project. There are not a lot of players at that check size level. Most won't go below 10 million because they're larger funds trying to deploy a lot of capital, and they can't get. It's not worth them to do a smaller check size. A lot of times they're doing it either a huge institutional investor or they're a smaller group that's doing syndications for every single deal, and so they have to go raise for every single deal. They don't want to go do it in a fund, and so it makes more sense for them to raise bigger numbers for one deal versus lots of little deals. But we have a fund that we can go pool all these into, and it increases geographic footprint, diversifies the risk across lots of different assets, and there's not a lot of competitors in that space, so we can go and take a market share and really command much better terms. That's going to be see less compression over time as more entrants come into the market. It's some of our advantage. We've been doing this for a long time, like I said, target investment size and speed. This is really part of why it works so well. We have a great track record in credit. I'm not going to do all this right now. Strong support team. This is part of what makes us great with our support staff and support resources here. CBIZ, they're doing our audits annually on this fund, tax preparation. Pulcinelli advised on SEC compliance, structured the fund. Dahl Rice, they're an attorney law firm that works on helping structure all of our deals with our borrowers' sponsors. Okay, next steps. So if you're interested in learning more about the fund, take a picture of this QR code or text the word credit to the number you see on the screen there. That will get you in contact with someone from our investor relations team. You can schedule a call, ask more questions. I'm going to run through some FAQs real quick. How long have we been operating this fund? Well, we've been operating this particular fund for about a little under 2 quarters. We've been operating funds like this and doing the exact same types of deals in other funds for over a decade. And so this is something that we're not new to. We've run open-ended funds before. We have a very extensive track record in credit, which you can look at more in depth online. Are you investing in distressed assets? Simple answer is no, right? We're not going to distressed assets. We're taking advantage of the lack of available credit and capital available in the market to position ourselves nicely into that middle of the capital stack, preferred equity, mezz debt, get those risk-adjusted yields that are higher, and be able to have some of those control rights and capital protection. So why would an operator pay us 16% when I go to a bank? Well, this is a great question, but it's something that we've talked about already, right? The banks, they're having to pull back in leverage. They can't do the same types of leverage they could even just a couple of years ago. There's structural challenges in the banking system. And at the end of the day, we are not always competing, I would say, with banks. We're competing more with equity, right? So with the sponsor, the way they view us is we're actually at 16% cheaper than their equity, right? Because they're having to give their equity, say 17, 18% net, and probably have to give them 20, 23% gross. So we're cheaper. So we actually increase the returns for their equity, and we can write a bigger check versus having to go syndicate it from all their investors. So it actually is a benefit to everybody involved and why they want to work with us. Well, what's involved in underwriting an asset? A lot. I mean, just in the past few months, we've looked at over $100 million in deals to fund only $11 million. We have an investment committee of 4 of our partners. All 4 partners are voters on the investment committee. All 4 have to unanimously agree to approve a deal for it to move forward. We also have outside advisors that speak into the underwriting and give their opinions. as Aspen, have invested personal capital principals into the fund. They will continue to do so as the fund grows over time. So what's the difference between the target cash yield, target return? Well, again, the target return is that total return that you get with the distributions plus the capital account increases from that profit share that goes into your net asset value in your account. The cash yield is what of that return is actually being distributed in cash, right? So most of the return we expect to be paid out in cash. What's the lockup period? It's a 2-year lockup period, like I said, with a 90-day notice. We want to start seeing returns. We have a 90-day delay for your accrual before you start seeing those returns. But then right after that, you start getting those monthly checks. This fund is a great fund, great fit for self-directed IRAs or an IRA or 401k that you may have sitting out there. You don't know what self-directed is, reach out to our team. We can tell you all about it. Put those monies to work into a consistent compounding fund that can keep growing. All right, guys, that is it. That's all we got for today. And there's a lot of information, a lot of things we covered. Please reach out to our team. We have some room for people to come in this quarter. We have a very full pipeline of deals. Feel free to jump in. If you like what you see, take a picture of the QR code, text the word credit, reach out to our investor relations team at investorrelations@aspenfunds.us. And with that, thank you so much.